Welcome back to PsychVids. Today we are focusing on the disposition effect.
Okay, let's dive into this. Picture this, you buy two different stocks. Fast forward a couple of months, right? And one of them just absolutely skyrockets. What do? Well, if you're like most of us, you're going to sell it pretty much immediately to lock in that win. You want to feel successful. But the other stock plunges. It's tanking, headed near zero. Instead of just cutting your losses, you hold on to it. You convince yourself, hey, it's going to bounce back. Why in the world do we celebrate those tiny wins by cashing out, but irrationally ride our bad decisions literally into the ground just to protect our egos?
This core paradox we all face, it's actually known as the disposition effect. It was coined way back in 1985 by researchers Hirsch Sheffrin and Mir Statman, and it's basically one of the most well-documented anomalies in all of behavioral finance. I mean, economically speaking, pure rational logic tells us we should do the exact opposite, right? You should sell off your losers, get those tax write-offs, and let your winning assets run. Let them grow. But psychologically, our brains are just hardwired to grab that quick dopamine hit from a win while stubbornly, fiercely avoiding the reality of a loss.
Section 1. The Psychological Engine. Let's look at why we do it.
To really wrap our heads around this, we have to understand prospect theory, which was pioneered by legendary psychologists Daniel Kahneman and Amos Tversky. And a huge piece of that puzzle is this concept called loss aversion. It reveals a really profound truth about us as humans. The pain of losing something is roughly twice as powerful as the pleasure of an equivalent gain. Think about that. We are incredibly averse to loss. A $50 drop in your portfolio cuts you way deeper than a $50 gain brings you joy. So, when we're in the red, we suddenly become huge risk takers, absolutely desperate to avoid making that loss a permanent reality.
And this brilliantly illustrates the mental trap we end up falling into. The whole idea of, hey, it's not a loss until I sell, that is literally the battle cry of the disposition effect. It ties right into a concept called mental accounting. Basically, we treat every single stock or decision as its own separate little mental ledger. Selling a losing asset, well, that forces us to officially close that account and admit failure. But as long as we just hold on to it, even as it's bleeding value, we preserve hope. We just tell ourselves, oh, it's just a paper loss.
At the end of the day, we are just fiercely trying to avoid that crushing, sinking feeling of being wrong. This is called regret avoidance. Because selling a loser means you have to look in the mirror and acknowledge you made a mistake. So we delay that emotional pain. We just wait for a comeback that might never happen. And you'll notice this overlaps big time with its close cousin, the sunk cost fallacy, where we end up throwing good time or good money after bad purely because of what we've already poured into it.
Section 2. Real-world market evidence.
So let's look at how this psychological engine actually plays out when real hard cash is on the line. Back in 1998, a researcher named Terence O'Dean ran this massive study. And the data? It's pretty striking. He analyzed 10,000 individual brokerage accounts to see how often everyday investors realized their gains compared to their losses. And the findings were just crystal clear. Individual investors disproportionately cut their winners short and held on to their losers. They were way more eager to cash in on the green and just completely ignore the red.
Now, what's really interesting about this slide is the painful irony of these decisions. Odean's research proved that the assets these folks sold early actually continued to rise. They ended up outperforming the losing assets that they so fiercely clung to. Think about the opportunity cost. By cutting their winners early, they essentially capped their own gains, all while letting their losing assets just compound the damage to their portfolios.
And this bias is only amplified in today's modern markets. Take the crypto space, for example. The extreme volatility there triggers massive emotional swings, making loss aversion even more potent. We see the exact same thing in meme stock communities. Investors turn holding a dropping asset all the way down to zero into this sort of badge of honor. They transform individual regret into a shared community identity. And hey, it's not just amateur day traders doing this. Studies actually show that disposition-prone professional mutual funds see 4 to 6% lower annual returns. The cost of this bias is just massive.
Section 3. Beyond the stock market.
But, this explainer isn't solely about finance. This cognitive trap bleeds into the most critical areas of our everyday lives. Think about the disposition effects we all experience away from a trading screen. I mean, have you ever stayed in a failing relationship purely because you've already been together for years? Or what about sticking it out in a dead-end career path or a degree program because of all the time and tuition you've already spent? We totally refuse to admit defeat. Whether it's an unused gym membership or some unfinished creative project just gathering dust in the garage, we anchor ourselves to that initial investment. We choose to ride the loss instead of just walking away.
Section 4. reprogramming your brain. Let's move to and see how this builds into actionable strategies.
So we need to reprogram your brain to fight back against this bias. Here is a data-backed action plan to help you override those hardwired emotional responses. Step 1, you have to pre-commit to specific exit rules. Whether that's setting a hard stop-loss order on a trade or giving yourself a firm time limit on a new project, set those criteria in advance before your emotions can cloud your judgment. Step 2, shift to portfolio-level thinking. Look at the big picture of your life or your financial performance rather than obsessing over one single individual position. And step 3, normalize your losses. Start treating a loss as just useful data. It's data that helps you reallocate your resources better next time, not some permanent reflection of your personal worth.
So the crucial point is utilizing the ultimate reframing tool. We call it the clean slate test. You need to ask yourself, if I didn't already own this stock today, or if I wasn't already invested in this project, would I buy into it right now at this exact current price or state? If your answer is no, then you need to walk away immediately. It's tough, but it breaks that mental accounting and literally forces you to evaluate reality exactly as it stands right now.
Ultimately, awareness is the very first step to making better decisions with your money and with your time. So I want to leave you with this. What loser are you clinging to right now simply because you don't want to admit you made a mistake? Subscribe so you don't miss an episode.